Good afternoon, everybody. Welcome back to the Opportunistic Trader. It's about 2:30 on November 8th, and we're joined by Tom McEntee. He's been joining us recently talking about good risk-reward opportunities in the equity and option market. How's it going, Tom?
Very good, Mike. It's kind of very sleepy day in light of the recent volatility we've experienced over the last 4 or 5 weeks. But
It
that's to
was
be, I guess that's to be
super,
expected.
super sleepy, waiting for the Fed. The Fed came and, basically was 100% in line. But we are now, we just in the last 5 minutes took a turn, or in the last 3 minutes. S&P is on the low of the day, down 15. We're at 28.02 right here. The yields continue to grind a bit higher, like we've been saying. Nothing too aggressive, but higher, and they're basically all at the high of the year. So, that's something to keep an eye on. But S&P right here, it was a huge day yesterday. I guess the past 5, 6 days has been a huge rally, and so now we're down 14. Nasdaq's down 61. So it's interesting markets. But I know we want to talk about some earnings. We got Disney. So let's take a look at what we're looking at for Disney after the bell.
Yeah, sure. 9%, 182, 34, 8%. Okay, yeah, Disney. Where are we, fellas? Okay, Disney here. This is what I want to look at. I put this in the chat early this morning because just to get the ball rolling, so to speak. And Gabe B, I wanted to do something to the short side because, as you may or may not have guessed by now, I'm kind of a contrarian. So I am of the belief that this thing pulls back. I'm assuming you can see the chart here that I'm about to enlarge. I'm of the belief that I don't know what the hell I've got going. I think we pulled back to like the 108 level. I remember I was trading this thing up in here. Was like $98 somewhere in here, 98.70. I think, and we got as high as 120, 119.70 or something. Yeah, 119.69, 119.69. I think I peaked then. So that's about what was that 22 points from 97.60. Yeah, so 22 points, 11. I like the 108, 109 level for a trade. Uh, this is another one where I think I think it might have overshot something. I don't know if this is a head and shoulders. Whatever. I mean, it's a poor man's head and shoulders. We got as high as 119.69. I'm looking for the thing to go back to 108. And to that end, I believe in the chat, I want to buy the now here I'll tell you what the spread is, and then we'll go into why we did it. I want to buy the November next week's 111 puts, November 16 expiration.
Okay.
And I want to sell tomorrow's, the November 9 expiration. I want to sell the 112 puts. I was bidding a nickel. I have since gone up to 9 cents. I have not been filled. I have not even dented the dish, so to speak. So
Where is it trading? Is there a market on that spread?
Yeah, I mean, I could have bought it this morning. I probably could have bought it like 7 or 8 cents, but I don't really. Like I said, I just step, but I very rarely step. I think this was cheap enough. I should have put in a more aggressive bid when I did it this morning. That's on me. I probably could have paid 7 or 8. I definitely could have paid 7 cents or 8 cents on legs. That's not a problem. I'm bidding 9 right now. I think you can pay up to a dime. I think if I'm right, I'm going to knock volatility. We always talk about this, Mike, where volatility will reside in the month we own. Now, where is this thing? Okay. Let me see if I can get this up. Walt Disney. Where is Walt Disney? Okay. I want to be able to show this to you. All right. This is Yelp. I'm foreshadowing here. Good. This is Disney. This is Disney. This is a chart of. This is like a 1-year chart of Disney 30-day vol. Okay. Now, obviously, like you can pick any 3-letter or 4-letter name, and they're all going to have the same volatility profile for the last 5 weeks, 6 weeks, right? We hit a nadir somewhere around 15 on October 2, and then we got as high as 30, which is as high as it's been all year in Disney. Currently trading 30-day stuff, not tomorrow's binary stuff. Currently trading 22. I'm going to knock, I'll knock volatility. I don't know if I'm going to look at next week's volatility because I'm not going out 30 days. If I can buy the spread at at faster than a nickel, I can knock the spread down to about 20. I can knock next week's volatility down to about 20, and I'm going to get the spread right now. You pay a dime. The spread's worth 20 cents with the stock at 118. it's worth 50 cents with the stock at 119. So obviously, you're going to have more of a geometric return profile the higher up you go. Obviously, what I'm trying to do here is leverage. I'm sorry, what am I doing here? I'm just trying. You're going to have a 5x return with the stock at 114 and a 2x return with the stock at 115. Okay, so it's worth 20 cents at 115. It's worth 50 cents at 114. Okay, anywhere 112. If it tickles 112, that's the home run, obviously, right? Because by 112, the puts I sell at 112 go out worthless, and then I got a week with the 111s. So that's what we want. This is a low. I mean, this is what are you risking? You're paying a dime, I guess, right now, and you have $1 worth of spread risk there, right? Because it can go to the stock goes to 95. You're probably going to lose a nickel plus the dollar. But I don't know. I don't really foresee that happening. But I'm just forewarned, just forearmed. I've said a few times. That's a good spread. Then Gabe B. I have my opinion. He has his. He wants to look at Disney from the long side, and that's cool. And to that end, I fashioned something where we would leverage the recent high, this 119. Let me move this out of the way here. Mike, come on, you got to be impressed with this, right? I mean, this is something.
Technology skills have come a long way.
Yeah, this is like level 5 stuff, right? I mean, I don't want to, I'm doing some serial killer stuff on this with this machine right now. This is I'm going to leverage this high, this 119.69 high of October 22. I want to shoot against that. So to that end, this is absolutely seamless. I put the thing in the chat here. Where am I? Equity. Hold on. Momentito. I think it's the 121, 120. And what was my bid? I think I was bidding. Here it is. Now, I'm not bidding for this. I don't know if Gabe B is bidding for it. I mean, this is what I want to do. If you want to do that, if you want to look up in Disney, and that's cool. Like a good golfer when he's in trouble, you always look up. That's not me, but that's what good golfers do. November. You want to buy the November 16. Next week's 121. Sell tomorrow's 120. Call spread, obviously. Pay a nickel bid for that. All right. So coincidentally, they're both nickel bid spreads. Okay. I'm trying to leverage historical performance. Yeah, that's important to say also. Right. Post release on the extremes. Disney's plus or minus 2.7% 1 day later. So we'll call it 3%. 100. It's $117 stock. What's that? $3.50, give or take. So that's 120. So coincidentally, I mean, in here, I know the stock's trading 116 and a half or so right now. Coincidentally, in here, 350, put the stock at 120 at or near the old high.
All right, so let's go over. Can you go over the payout profile? So you're selling the 120 for tomorrow and buying the 121 for what date?
Next week.
Next week,
no,
right.
16.
So what? Give me the profile. If Disney trades up to 125 tonight, what happens here?
Well, you're going to lose. I'll say that right now. Here's what you're going to lose. You look at this. This is just a simple freaking thing.
Well, that's why. Go over a few different scenarios here. If it trades up to 120, if it trades up to 125, if it trades down to 110. Absolutely right.
You're doing the spread. You're doing the 121, 120. You're doing the call spread. Okay. Now here it is tomorrow. We close at 120. That's the price up here. I'm long the 121s that expire next week. I'm knocking volatility down at 20. Okay.
Mm-hmm.
Well, my calls are worth 81 cents. I paid a nickel for that spread. So I'm going to get 15x on that thing. Okay, if I pay a nickel. Now that's the optimal thing. The stock trading at 120.
Right. Okay. But let's say if it goes out at 120 and a half, you're going to be long the stock.
That's okay. That's fine. Here, 120 and a half. All that's going to happen is this. Here. I'll even knock out the weekend. I'll say 20 days. I got 5 days of trading. You see what I'm doing here in this little box? I got 5 days to expiration.
No, I'm sorry. So you're actually going to be short the stock if it goes out at 120.
That's cool. That's all right. So now, here, I'm long a 91 cent put. I'm short the stock at 120 and a half. Okay. Essentially, I own that. What I own here is I own the 121 call at 91 cents.
Right.
And I'm short the stock at 120 and a half. What is the 120? Well, what is the 120 call worth with the stock expiring at 120 and a half?
Half a buck.
It's worth half a buck, right? There's no extrinsic value. It just has intrinsic value, right? There's no time premium left. So it's worth half a buck. So what I'll have left is I'll have that put on. So what I'll have on is I will be long the the 121 call at 91 cents, short the stock at 120 and a half. That would make me synthetically long the 121 put. You follow me? The 121 call against short the 120 call with the stock closing 120 and a half makes me short stock. So now I'm long call, long next week's 121 call,
Right.
short stock now because the 120s I'm short turn into stock.
Right.
Now I'm short that stock. That's trading 120 and a half. So I'm short the stock at 120 and a half. So I own the put. I paid a nickel for the thing. The thing is worth, the call's worth 91 cents at this particular point. You see that? 91 cents. Okay. That call is worth, the other call is worth $0.50, right? The next week's call is worth 91 cents. This is on Monday morning. And the call I'm short that's turned to stock is worth 50 cents. I'm long the spread for 41 cents. I paid a nickel. So that's a 7x return. So essentially what that makes me long is I am long that put for this price. Less what it's worth 86. I'm long it for $1.32. Okay. Now I'm long the 121 put synthetically. Long call, short stock equals long put.
Right.
That'll turn into, if you don't want whatever type of market risk might present itself next week, you can just take it off and buy the stock back at the end of the day because the short call is going to turn into stock and sell at your 121s, whatever you want to do, however you want to play it. Or you could just simply, buy the call back if the market's tight enough. Obviously, I think the stock should be much more liquid at 3:55 in the afternoon than trying to buy that call. So I would buy this if you don't want, if you want to take the play, you're happy. You bet a nickel it's worth 86. You bet a nickel it's worth 40 cents right now. So you make 35 cents onto the next one. That's cool. That's 7x. You can buy the call back and just take it off as a spread. Like that's important, Mike. I'm glad you bring that up. That's important. A guy told me a long time ago. Put it on as a spread. Take it off as a spread. I try to keep it as simple as possible. So my thing would be to take it off that way, or if you want to have the exposure that, hey, the stock's at a new high. I mean, I think it might encounter some resistance here, and now I'm long a put. You can hang on for the week, but that is what you will have at that particular point in time.
But that's important also. For the most part, you are thinking in terms of taking everything off as a spread, putting it on as a spread and taking it off as a spread.
Absolutely.
Initially. Now, when the time comes, you might decide short term to.
Yeah, I mean, look, everything comes in. Like I got some 1x2s in IWM that I put on at the bottom, somewhere at the bottom. I paid like 65, 70 cents for it. It worth like $2 now. But I'll take that. I'm not going to play around with that. Like the Apple push spread I bought, that's, now it's underwater. But I mean, I bought the 190s and next week sold the 192 and a half. I bought the 192 and a half back yesterday, 6 cents. I'm like, I wasn't going to, we talked about this before. I'm not sure any options under a dime in anything, least of all in a $200 stock. That ain't happening. So I covered those. I'll roll the dice with next week's 190s. So that's what you'll have left. That will be a residual position in Disney if the stock trades up to 120. If we go up to 122 and a half, you're going to be down about 30 cents. Okay, because what's going to happen there is, if you see here, the 121s are worth about $2.07. The 122 and a half, I'm sorry, with the stock at 122 and a half, the 120s are worth $2.50. Well, that's worth 43 cents against you. You paid a nickel, you're out 48 cents. So that's where you would lose. That's where you're going to lose there. So the most you can lose on the spread is the difference between the strikes, the dollar, 120 against 121, because you're selling the cheaper strike, and plus the debit. So the most you can lose on the spread is $1.05. I got a lot of luck with these. I've had some good luck with these spreads because we got a lot of stuff going for us here. Yeah. We know what the historical metrics are in earnings. We know we're shooting against an old target in the stock. I think there's a high probability you're going to succeed with this thing. And if you don't, what happens in most of these things, you're going to either rip up the nickel or maybe you make 30, 40 cents.
No.
And also, go ahead. I'm sorry.
I was just going to say that was great information. A lot of the different education things you just gave there, a lot of great information.
Yeah, that's cool. And now we'll do Yelp.
Hang on before we even get to Yelp. Well, okay, let's go Yelp. I got a few things after Yelp.
What do you want to say? I can do two. I can type in
two things. One, I was just off the cuff, just looking at Tesla. What an amazing mover that's been. I know that we've talked about that a few times.
Yeah.
Not recently, but that thing back to 350. We were. 2 weeks ago in striking distance of just crashing, and now we're in striking distance of just ripping through the highs of the year.
Yeah, like, you know what? Hey, that's a great thing. Everybody loves Tesla for whatever
Everybody
reason.
loves it,
Let's talk about it.
except for the shorts at the
Uh,
moment.
yeah, let's talk about that. I tried to do the spread yesterday. I did not get it. Here's what we talked, Mike. We've been talking about this a lot. We've been talking about that variance spread in Tesla that's presented itself like the 25 delta put over the 25 delta call in Tesla. Since I guess August earnings. Late August was up. Yeah, 731, 881. Yeah, here it is. Now you notice it. Here we go. It's here the thing got the spread got to like 13. Look at it now. All of a sudden, it's in the news. When the stock traded 380, the spread got depressed, and all of a sudden, when it when things were bad again, the spread, this 25 delta put over the 25 delta call, got as high as about 20. Put vol minus call vol. Okay, you see that, right? You can see that. I don't want to move this thing unless you don't see it. So that's about 20. Got down to 12. It's been gyrating. Okay, right now, let's look at it right now. Now the right now is trading about 11, so it's coming in a lot from where it was. Now it's also important to realize it's 11. I want to show you this here, which is really here. It's 11.7 on a 49 volatility. Okay, now as a percentage of premium, it's about 27%. Okay, you see how I get that? Like roughly 12% against a 30-day implied, about 49. So that gives you about a 27% put call premium, which is important. Okay, and the 52-week average has been 18. It's still somewhat elevated, but down about 50% from where it was. It was trading as high as 20, down about 45%. So this is what I would say in Tesla. I tried to do this. I couldn't get it on. Now, you and I spoke. This is the chart of implied volatility in Tesla, right? Here it is at its apex, middle of October trading, 30-day stuff, 80 vol. Come get it. Now here it's 49. Maybe since not since August 31 have we seen volatility this cheap. Now, what I think is interesting here, and now it kind of dovetails back to what you and I were speaking about last week with VXV versus VIX, right? That kind of was the first volatility statistical metric, I guess, for lack of a better word, to turn. Just let me see it. I want to compare expirations. That was the first one to turn, right? Where VXV traded over VIX, first time in about 3 or 4 weeks, where we're traded over VIX. Obviously, during the tumult, VIX was trading higher. VIX, the 30-day instrument. I'm sorry, the 30-day instrument was trading higher than VXV, the 90-day instrument. Now that's VXV turned over, went to a debit over VIX last week, like last Wednesday or Thursday, and now I think this morning the futures curve followed suit. The VIX futures curve followed suit, where it's all pretty much everything in contango. Okay, so it's a more normal volatility slope throughout the volatility complex, I guess, for lack of a better term. Now, I think that will give us, like what we were trying to do in Tesla, I thought was, and indeed a lot of the spreads I was putting out, especially with spiders, was I was a buyer of duration. I was buying time. I was buying December 77, selling those 75s, that kind of stuff, because the skew between the front tenor and the back tenor, say 30-day stuff and 60-day stuff. 30-day stuff was trading about, I'm going to say 3 clicks over, 3 points over. Figure 20 against 17. That's an enormous premium if you stop and think about it, right? 30 on 17, 30 on 17 is about 18%, right? That's a pretty big. That's 17 squares 29. Yeah, okay, so it's about 18%. So that is a pretty big number. So I think there was a lot of embedded edge in doing things like that. Now I think in Tesla here, you're getting an opportunity to, I think, avail yourself of gamma. You might be short some Vega, but I think the gamma may outweigh the Vega. Gamma is rate of, what gamma is, right? Rate of change of delta. Right. Okay, so you're going to have your underlying equivalent stock position, delta, will change. Gamma will change that. Okay, if I'm flat delta and I have a 500 gamma, we'll say up or down $1, I pick up $1. If I'm positive 500 gamma, up $1, I'm long 500 deltas. Down $1, I'm short 500 deltas. If it's $2, it's plus 1,000, short 1,000. That's gamma. You can get gamma here. You can avail yourself of gamma. I was trying to do this spread in Tesla yesterday. Didn't get it. I want to sell stock up in here. I think any of these spreads where you can now, it's got earnings coming out, Feb 19, I think earnings, but now you got some, what's happening here. And I think it's important to note for anybody out there trading options, and you got to be aware of this. Like you and I spoke last week, I thought volatility, SPX vol was coming into 14. It's kind of heading there. I haven't really bought anything yet. I think so today, this afternoon, tomorrow, it may trade 14, but I'm not going to empty my revolver. I'm not going to empty out the chamber right there. I think I want to scale it to it because you got to realize there's a couple of important things coming up. Seasonality being what it is, you've got the holidays on the horizon. So I think you want to be a selective buyer of volatility in here. SPX vol is probably going to trade 14 this afternoon, probably by tomorrow, because people get desperate Thursday afternoon, certainly on Friday if nothing happens. They don't want to be sitting with the weekend. And now you've got the augur of Thanksgiving out there. So you got to be cognizant of that, and you just can't be willy-nilly. I think the market may enter some type of a normal phase right here, however long that takes. But I mean, you long 30-day stuff, and that vol comes in 3 or 4, 2 or 3 clicks, and you got 1,000 Vega. Well, that's going to be expensive, right? For 1,000 Vega, 2 points is $2,000. You got to be selective in buying volatility right now. I thought 14. I'm a buyer at 14, but I'm not buying everything I can at 14. I'll scale it in. I'll try to, I'll just try to buy it down. I don't think this new volatility regime is over. I just think you want to be a selective buyer in here because you've got some headwinds. You got the contango headwinds in VIX futures. You also have seasonality, which is going to work against you. And believe me, having been on the wrong side of a couple of long holiday weekends into Thanksgiving, that's never any fun. So once again, forewarned is forearmed. This is what I want to do in Tesla. I think you want to avail yourself of this. You can get some cheap gamma here. I would buy something like what I was trying to do yesterday was buy the stock was $5, was about $5 lower. I didn't get it done. I want to buy a 40 Delta call in December. So that's about, what's that, 6 weeks, 5 weeks? 40 Delta call in December. So we'll call it like the 370s. Okay. I could pay about roughly about 1550. Regular weight deck 370s. I could pay 1550. I want to sell the Jan. Right, the Jan's up here. I want to sell Febs. I'm sorry. What am I looking at here? This is the earning month in Feb. I think they're going to come for the Febs, and I get it. That's cool. I want to buy the Jan 370s. I want to sell the Feb 410s. I can pay 1550, sell them at say 1630. I can take in 80 cents on that spread. I'll have 8 deltas. You see the delta on the Jan 410s is 32. The delta on them, we're just going to shoot against that 420 level that Musk spoke about 2 months ago in his tweet. So I'd be short a 32 delta call. I'm long a 40 delta call. That's 8 deltas. Now look, Tesla's a $350 stock at 50 volatility. You got to size it up accordingly, right? I'll keep it simple. If I buy 12 of these spreads, 12 times 8 is 96. That's 100 deltas. I'd sell 100 shares of stock. Okay, now 100 shares of Tesla. You find another 50, find a 50 vol stock, find a $35 stock at 50 volatility. It's like trading $1,000. It's trading like being short 1,000 shares of that stock. So that would be somewhat congruent. So just be aware of that. So 12 spreads. If you want to do a delta neutral, just try to trade the gamma. I think you'll have a good opportunity because volatility has gotten very cheap and you're still able to sell the elevated back month because of contango and because of the earnings thing. And I think also, hey, look, it might get cheaper. So nibble, bid, and then be prepared to buy more. You ain't getting the bottom. I never get the bottom except when I sell. But I mean, that's a good spread. Now we got one more earnings play, Mike. Yelp. But this was
let's do Yelp. 5-6 minutes on Yelp.
Done. Yelp. Here's what I like. You ready? I come on here prepared, bro. I've got a lot of legal pads in front of me. Here, I want to look at good spread here. Yelp. I went back my standard 8 quarters. Okay, for 8 quarters, the extreme one-day move, up or down like close to 17%. Okay, that's a big move. 1, 2, 3, 4.
Looking back at this chart, it's funny. We've really been locked between about $40 and $50 for a while now.
Yes, and I think it bounced off. I'm just where was it?
We've tested both ends of the range. We got up to 52, I guess, but roughly, I guess it wasn't too long.
I want to look at what do I want to look at? That's a good question. Here's Yelp. Let me get a chart up here for it. Chart to show. I got these moving averages and stuff like that. And I have no idea why they're on every stupid chart of mine. I want to look at the 48 level. I think it's a midpoint between this 39. I think the low, it was a low $39. I think a couple weeks
Yeah,
ago.
it looks like it.
$39, and this all high was 52. So what's that? 91, 46 in here. I want to look at that 47, 40. I was looking at 47, 48. But you know what? Hey, they always go a little bit further. Let's look at this last high, whatever the hell that is. That last high was 48.20. I want to leverage that. I think I got a real cheap spread here. I want to shoot against that 16% thing because I know that 1, 2, 3, 4, 4 of these 8 quarters have been 18% or less. Okay, and indeed 3 of them have been 14% or less. I want to shoot against that and say, hey, I want to I want to sell this week's 48s, tomorrow's 48 calls, and I want to buy next week's. Look at this. I'm just going back and forth. Mike, come on. I've come a long way in 3 months, right? I mean, you got to these strides I've made. I want to sell tomorrow's 48s. The we'll say $1.50 by next week's 49s. I can take in 20. I want to buy next week's 49s, sell tomorrow's 48s. I'll take in like 15 cents. Easy. 15-cent credit. Okay. That's a good spot. I'll knock volatility down to 50. Right. Now it's trading 111. And this is important. We speak about this a lot. It ain't going to be 111 tomorrow. After the binary, it's a binary event, obviously. So I'm going to knock volatility down to 50. That might be aggressive. It may trade a little bit low, but I'd rather be a little bit more cautious than that. I'll knock volatility down to 50, and you got room up to 50 and a quarter on the upside, and that would roughly be, that's about $7, right? 17% would be $6.80. I'm sorry, $6 to $7.30. You got room all the way up to that 17%. Extreme move, which I think it may correct itself the following. I think it's a cheap long side look. On the downside, if the stock trades $12, you're going to pocket you're going to pocket 15 cents. On the upside, you got room up to 50 and a quarter. That's a real good spread. I'm going to put that in the chat and bid for it right now. I would definitely, you could probably do it for 20-cent credit. I'm going to offer it at 17. See if there's any fish out there. See if they're biting, and then on to the next one. But that's a real good spread. Yelp. Next week's 49s, this week's 48s. Buy next week, sell this week, plus 15 cents. Calls. Good spread. You got room up to 50 and a quarter. Okay, that's knocking vol down to 50. And that's what we're going to be. S&P, you want to do a minute on S&P?
Actually, no, I got to hop. I got something coming up at 3, but that was great. Yelp, I'm definitely interested to see that one. Been following it a little bit, and it'll be an interesting quarter. But yeah, it's been in a kind of a tight range. Real quick on Yelp, where's the straddle for today? I'm sorry, for tomorrow.
I'm going to say probably $7, but we'll take a look. I'm sorry, it's 6.5, 6.45. So what's that? About 15% roughly?
Yeah,
about 6.5. The things are moving, man. But I want to shoot against it a little bit. I think we're a little. Maybe we're closer to the top than the bottom. I think 48's a good spot for it. I'll play it. I do it for a credit. If I got a lot of room, and if it does move 17%, that's kind of where I'm at. In terms of my break even, that's a good spread. That's another good spread. Another, I think, high probability of reward in this one. But I'm going to put it in the chat, and hopefully it works out.
Great. Tom McEntee, thank you very much. A lot of great information. Really appreciate you taking the time. You were on Tuesday and Thursday, double duty. A lot of great information. Earnings, it's been busy times with earnings, so we appreciate it.
Great. Just hope we're just able to, just talk about stuff, and maybe people pick up on something, can glean some stuff what we're talking about, and just trying to be as helpful as possible.
Absolutely.
Hey, thank you so much for having me.
We've gotten good reviews on the Tom McEntee segment. A lot of education, a lot of good information. So we appreciate it.
Hey, great. My pleasure, guys.
All
I
right.
appreciate it.
Talk to you later, Tom.
Take care, buddy.